these are the high growth players that are getting hit.
Right.
Some of them are high multiple players as well. It's where the growth has been. That's where the money has really sort of chased some of these names. We're now starting to pile back out. Are you concerned about where this is going?
No, I'm not. First of all, we're value, so we're kind of excited that the bloom is coming off the rose and some of the really expensive names. But secondly, again, getting back to rates and things like that, we think this is a normal short-term freak out where rates are going to be set at 3 or 3.25, and the market's going to be okay with that.
You value, but you hold Facebook.
We do hold Facebook, and
walk me through that.
Sure, that's an easy one. So as opposed to an Amazon or a Netflix, which are trading at 50, 60, or 100 times price to earnings, Facebook is less than 20 times next year's earnings. And looking out 3 years, which is what our job is, we see that as a terrific competitor with no other folks in that area to give them trouble.
Lisa?
I wonder how much also the tech route is tied to what we're seeing in China and the fact that we're seeing a faster than expected slowdown there. Not only that, but there is incentive for Chinese leaders to delay any kind of move from U.S. companies to China and the entire Asian market. That to me seems like a pretty big headwind for tech companies.
The argument from Mike Wilson over at Morgan Stanley is this is the final shoe to drop. These are the high growth names that attracted a lot of capital. In some ways, they attracted the haven flows as well because they had so much growth. And Mike Wilson said the following recently: given their lack of dividends, high valuations, high flying growth, stocks are arguably the longest duration assets in the world. Therefore, it's perfectly reasonable that they would eventually succumb to rising rates. So we're starting to see this rising rate story bite into the growthy tech story here in the United States.
Sure, but sometimes it's much simpler, which is that Netflix is still up, what, 70% for the year? And so it's the pause that refreshes. Look, we don't own Netflix, and it's a tough one to own for value. It's in fact impossible. But I don't think it's over yet. I don't think Netflix has hit its high for the cycle yet.
It's not over yet. And it's not seemingly over in the economy either.
No,
it wasn't credit,
no coincidence.
Just when you look at credit, I would expect to be really worried. You'd have to see high yield credit dramatically gap lower. We don't see that over the last week, Terry. You must take some confidence from that on where we are in the cycle and what it means for growth.
For the U.S., yes.
Absolutely.
When you talk about where we are in the cycle, the second half of this year is probably seeing the biggest fiscal impulse. The stuff stemming out of the February bipartisan budget bill. All that spending that Congress and the President agreed to legislate back in February is hitting the economy right now. That's why the third quarter and the fourth quarter are going to see strong growth. That's going to transcend a little bit, maybe into the first and second quarter. After that, it's anyone's guess, but right now the economy's strong and there's no reason for credit spreads to widen in that kind of context.
2019, 2020?
For a recession?
For credit?
Oh, you mean for a spread widening?
Yeah.
Yeah, conceivably. There is going to be a little bit of a fiscal cliff after 2019. It's not going to be huge. Other things will be happening, but if I were to bet that spreads are going to widen, it's not right now. It's probably 6 months from now.
Yeah, you know, we paid a lot of money for this bull market. We might as well enjoy it. I mean, there's a lot of stimulus, and it's not going to go away this quarter or next.